Hey, how's it going, everyone? My name is Amos, and I'm going to explain why investing $500 a month is worth it. Because think about it like this: if you work and just save your money as cash, you're actually losing money over the long run due to inflation, meaning your cash will be worth less in the future. Because when you look back at history, the price of a gallon of milk in 1988 will make your nipples hard. Because 36 years ago, it was very inexpensive. That's why some people choose to invest into real estate so they can flip houses or rent it out to people. By the way, shout out to everyone who invested into Airbnb rentals and now they're facing a lot of backlash and artificially increasing the price of homes of all the nearby neighborhoods, effectively pricing out all the millennials and Gen Z from buying a home. But jokes aside, if you invest that money into the stock market instead of Airbnb rentals, your money will not only grow, but your money will work for you. As an example, if you had invested your money into the S&P 500 in the past 10 years from August of 2014 to now August of 2024, your money would have grown by 227%. This is a fact. This is not a hypothetical. This is not an illusion. This is actually what happened. So your money invested into the S&P 500 would have worked for you by making more money. The compounding effect, as the name of this channel might suggest, is a real thing. No, this is not cryptocurrency or sports gambling where your money can triple overnight. However, this is a slow and steady methodology to build a cute portfolio. And I promise, here in a little bit, we are going to show the consequences of investing $500 a month. But before we do, I know it sounds crazy and counterintuitive, but right now is exactly when I like to invest into the stock market. When there is a lot of fear in the headlines and big investors are pulling their money out saying, hey, I don't feel good about the stock market right now, that results in stocks going on a big dip. Meaning the price and valuation of a stock, say that trades for about $100 and it drops down to $65, if nothing else fundamentally changed and the company is just going to be doing business as usual and making cash flow going forward, why the heck would I not want to buy it? That's why I think of it as shopping with a discount code. And for a retail investor like me, it's an opportunity to get high quality compounders on sale. If I enjoy the idea of buying Starbucks at $80 a share, why the heck would I not want to buy it at $70 a share? But investing into the stock market when there is a lot of fear is the kind of stupid like making out with your cousin. Am I right? Over the past 100 years, what you see on your screen right now, the annual rate of return for the S&P 500 has been 10% year over year, meaning your money would have grown by 10% each year on average. And yes, every so often your money would have gone down, which is represented by the red bars on this graph. But without a doubt, the American economy always rebounds and goes to a new high. And no, I'm not just saying that out of my butt. Rather, it's a fact and a statistic that you can Google for yourself. Yes, there are pessimists who think the American dream is not sustainable, but they've been saying that for decades. They say, oh, the American economy is just going to crash, and the growth of the GDP and all of these companies is just temporary. This cannot be sustainable, but they've been saying that for decades. So I just drown out that noise despite their good intentions or fear mongering. So if you just look at the facts and make decisions based on logic and not with emotions in regard to money, it's easy to see that sometimes the market goes up, which is reflected by the blue bars on this graph, and sometimes the market goes down. So even if there's fear in the market, I know I'm going to be okay by looking at the data and the historical numbers. With that said, let's go ahead and see what happens when you invest $500 a month every single month. And we're going to be going over these hypothetical scenarios with various timelines. We are going to assume you're investing into the S&P 500, which is the benchmark most investors try to beat, aka the market. So if you pick your own investments, you potentially could do better or worse. But for simplicity's sakes, let's go ahead and say that you're investing into the S&P 500. And you're going to start out with an initial $500 investment and then externally contribute $500 a month for 10 years straight. And surprise, surprise, the investment choice will be through VU, which is an index fund that emulates the S&P 500. So 10 years of contributing $500 into VU every single month. Let's go ahead and see what happens. What you see on on your screen is the growth of your money from year 1 to year 10. So in the first year, of course, that initial $500 at a slow and steady pace as you go all the way up to year 2033. So the question here is, you got to ask yourself, would I rather have $60,000 in cash after 10 years or have it turn into $90,000 through the S&P 500? Because the principal amount that you would have contributed to the market would have been $60,000. I don't know about you, but 90,000 sounds a lot better than 60,000. Sometimes bigger is better. No, I'm not a Texan, but in this case, it just makes a lot more sense. So whatever your retirement goals are, having a bigger portfolio is not a bad idea. And I know when you look at this number right here, it looks kind of small, but the whole game plan here is to grow your money as much as possible in a predictable and moderate way. So think of the dividends as the cherry on top and not the focus right now, because once you retire, then the name of the game and the strategy should change. But as you are accumulating your wealth and trying to grow your money, the name of the game should be growth. And next, we're going to go ahead and look at what happens after 20 years. But before we do, let me go ahead and share a funny history lesson. So ancient Korea, starting in the 14th century, had this thing where a bunch of scribes would follow the king around and document their day-to-day life, mostly to highlight their accomplishments, their victories, and court rulings. Because prior to that, it was a telephone game to remember what the last dynasty and emperor did, and then you would just be forgotten. So the Korean royalty wanted to be a part of history so that future generations could hear of their glories and why they should be studied in your history textbook. Anyways, fast forward to King Taejong, the guy that you see on your screen right now. This is not really him, but this was a Korean drama depiction of him. The dude was a clean, royal guy that had an easy life, meaning he wasn't a man's man. So one day, he went hunting while riding on a horse to increase his toughness points. And my man fell off his horse while fumbling with his bow and arrow. The historians saw what happened and wrote it down into their little scrolls according to their instructions, because that's what they're supposed to do. And when the king fell off his horse, of course he was embarrassed, but he was more pissed off at the fact that the scribes wrote down his little incident. And because he was so embarrassed, he ordered for those scrolls to be destroyed so that no one would ever know that he fell off his little pony. And when you're the king and you tell people what to do, of course they're going to get it done. And so his servants found that scroll and burned it, effectively deleting that little incident. However, the historians knew that they had to preserve the integrity of real history. So they made multiple manuscripts of that horse event and hid them all over the palace, all over the dungeon, all over your ex-wife's boyfriend's closet, so that the king could not destroy all of them. To put it into context, it's like ramming your car into another parked car, or pooping your pants while you're stuck in traffic, which, by the way, there's no shame in that. I personally dropped a protein bar in my pants twice in my life. Or I guess a better example would be, think of someone famous with a lot of power in this world, like Elon Musk, and how, as of recently, he was challenged to an MMA fight with Mark Zuckerberg. When another tech billionaire challenges a tech billionaire to a fight, you gotta agree to the fight. You can't refuse it. The shame and honor aspect carries a lot of weight for us men, regardless of who you are. All that to say, I can see why King Taejong wanted the part about him falling off a horse to be erased from history. Now, back to the video. I thought that was a little funny story. Same parameters and variables, but instead of 10 years, now we're looking at what happens after 20 years. Look at the journey of your money from year 1 all the way to year 20. After 14 years, your money would have grown to $160,000. And in just a short span of 5 additional years, that 160 grand would have doubled to $313,000. So again, the question here is, after working and saving my money over the span of 20 years, would I rather have $120,000 in cash or have my money transform into $300,000 through investing into the S&P 500 and contributing $500 a month? My gosh, that is a mouthful. That's what she said. And when you look at the bottom of your screen with the red arrow, yes, the dividend income after 20 years is not the highest, but think of it as gas money, because $3,400 a year in dividends, not bad at all. And now, here's where the magic really happens. By changing the investment timeline from 10 years or even 20 years to 30 years, look at how the money compounds. Because once you have more money invested into the stock market, the bigger and faster that it actually compounds. That's why everyone always talks about that first $100,000 being so important. So if you just look at year 20 to year 30 alone, the money goes from $300,000 to a little above $800,000 in about 5 or 6 years or so. And that compounding happens while still putting only $500 a month into this portfolio. And then that slice of cheesecake at the end of your meal, look at the annual dividend income. Now it's $8,300 a year. So instead of gas money, we can consider the dividends after 30 years as enough to pay for your groceries and even utilities. So as a general rule of nipple, the longer you keep your money invested, the more you benefit from compound growth. It's also worth mentioning that consistency is just as important. For as the market grows and you reinvest the dividends into your investment, your principal amount of money is going to double and compound over the years. Unless, of course, you decide to invest into all or nothing speculative nonsense. Then all of this goes right out the window. Because if you invest into companies with a shaky balance sheet and inconsistent cash flow, you're basically gambling. You're not investing. You're either going to triple your money or eat instant ramen for the next 10 years because you're broke. That's why, for most people, they're better off investing into an index fund like VTI, VU, or even SCHD. By the way, I have videos made about all of those. Because when you bet on the market, your probability of sleeping sound at night goes up by a lot. Of course, that's if the S&P 500 behaves and performs the way it has for the past 100 years. Which, beg your finest pardon, I think going forward, we're going to be okay. It's a slow and steady race. And remember, investing is a matter of the stomach and not the brain. Do you have the stomach to keep investing when there's a lot of fear and uncertainty filling the headlines? Because if you have the stomach to do this and the patience, you're going to be more than fine in the future. With that said, I'm going to talk to y'all next time. Stay safe. Amos signing out.